Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out those charts, positive and negative, that seem to be saying something right now. And I group those up into a positive side and negative side. And then the last section that I go through are just things that I'm keeping an eye on. Now, as I record this, it's a few hours after the U.S. was involved in an attack on Iran, but still over 24 hours before the futures get set to open. So we'll have to see what kind of reaction that is going to bring, not only when the futures first open Sunday evening, U.S. time, but how's that going to affect Europe, and then ultimately the open in Monday's session. So there's some variables out there, and there's plenty of time for other things to happen too. So we're keeping an eye on everything that's going on right now to see what kind of an impact it may have. But we're asking the question this time with this video, will geopolitical escalation, which now it's done because the US is involved, will it derail the S&P 500? And this is being prepared for Monday, June 23rd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, first we go through the positive side here. And this is all based on Friday's close. The futures shut down. All the markets shut down because oil is probably going to really jump. That's just the speculative take on it right now. We'll have to see what really ends up happening. And the market doesn't like geopolitical unrest, even though we've been living with it for quite some time now. But when you look at this particular chart, it's still holding up for the time being, where I'm having a heck of a time getting my laser pointer going here. We're still seeing the blue line above the red line. This is an intraday chart of large cap growth to value. Now, they both declined in Friday's session, and it's not like they've been really performing all that well lately, but they're not necessarily falling apart. And so we'll keep an eye on this. It's typically more positive when the blue line is above the red line, but you can see there's other times when the red line is above, but the blue line still does well anyway. But we just want to keep an eye on this to see how it's going. Now, this is one that I probably pay more attention to. It's growth versus value intraday just for the S&P. And as we were coming up out of the April lows, this ratio continued to really go up. And then pretty much we got into the latter part of May and into June, and we've been just chopping along sideways. We took a bit of a hit in Friday's session, but we're just down pretty much to the low end of this range. We'll see if this is going to shift and actually turn more negative, or if it will continue to hold up if stocks become more under pressure. This is an end-of-day chart of S&P growth to value, and even though we've been going along sideways, seeing some recent weakness, we have been above both of the moving averages enough to generate an uptrend with this ratio. The growth to value ratio here between two ETFs, this is still holding up for the most part. Small cap growth to value, even though the small cap index has really gone sideways at best and really underperformed a lot of what some investors had expected, the growth to value ratio is still holding up quite well, and also going sideways with the mid caps, but the growth to value ratio is holding up fairly well here. Then we do a number of different ratios of the Qs to S&P. This is still holding up above the moving average. The disappointing one is discretionary to the S&P. That continues to be below the moving average, and the moving average is going down. And we did decline in Friday's session when we compare large cap growth to value, but we are still above an advancing moving average, or right on an advancing moving average. We'll see if these end up dropping in Monday's session. So the large caps, looking at it this way, they're falling below the moving average. Mid caps are holding up fairly well here, and we're just back down to the moving average with the small caps. This has been one of the other disappointing areas of the market. Discretionary just hasn't really been doing all that well. Fortunately for this ratio, Staples have been just chopping along sideways for the most part, too. We are back down to the 200-day moving average with the equal weight discretionary to staples ratio, but we haven't really seen a lot of growth. As we were coming up out of the lows, this was improving, and then it's just kind of settled back here right down around its 200-day moving average. We'll see if this can show some strength or if it's going to follow through and show some weakness. Large cap growth still holding up for the time being. We're above all the moving averages plotted here of 50, 100, and 200, and we could be getting close to a golden cross where the 50-period moving average crosses back above the 200. We're not quite there yet. We'll have to see how things end up playing out, but this is at least holding up for the time being. Then we look at a ratio between high beta stocks and the equal weight version. As a general sense, this is risk on to risk off, and this is going up with this ratio, and that tends to be more positive, and it's been holding up fairly well. If stocks come under pressure early in the week this week, we'll be watching this ratio. And also the high beta, this is like Amazon, Apple, Google, Nvidia. This ratio has really been coming up too, and we'll see if that can continue when we compare it to low beta stocks, usually the more conservative, defensive type stocks. And this is positive too. We look at value and then look at the tech sector, which is the big part of growth. With this ratio going down, that tends to be more positive. And so far, that has been continuing. The stocks inside the S&P above their 50-period moving average were still holding up quite well here. The intermediate term trend is becoming a little vulnerable. It's the short-term trend that seems to be holding up for right now, but looking even more vulnerable at this stage. And so this seems to be holding up better for right now. We're well above 50. And then we're holding up above 50 with those stocks above their 100-period moving average. And when we look internally, this is longer term. This is a 50-period exponential moving average of the new highs, new lows for the S&P. We climbed back above zero, and even though we're flattening out here, we're still getting a positive result with this indicator. This is a weekly chart of the S&P, and I've been trying to point this out in other videos that we're still seeing this fairly constructive, a series of higher highs and higher lows for the most part. Now that's getting challenged a little bit on the daily side, and I'll point that out a little bit later. This is still holding up for right now. Now, is this going to get challenged too if we come under pressure due to geopolitical events? Now, we're still okay here. We haven't quite gone over negative. We're not trending, and this is a short-term ADX. This is what I use to determine the condition of the trend. The green line for right now is still barely above the red line. Now, if this crosses over and the red line goes on top, this is going to switch over to negative, but we're not trending now. The black line is the ADX. It's below its moving average, and it's below 20. But we've been stuck down here going back about to the middle or so part of May, and we're just not showing an awful lot of conviction. Intermediate term, this is the one that I follow the most. We see a little bit of daylight between the green line and the red line here, but that could cross if things are getting ready to change. Also not trending here. We're below the moving average and below 20. Now we're still holding up though. Oh, just to let you know, the reason why these are on the positive side is because the green line is still technically above the red line. Now the advanced decline line took not too much of a hit in Friday's session. It was actually up here. The reason why this is positive is because we're still above these moving averages, and the moving averages are still going up. And we had been negative and turning more negative with the advanced decline oscillator here. And in Friday's session, this was able to cross back above zero, so it's turning more positive again. And the vortex is showing the green line above the red line, so that's positive. And for right now anyway, the 20-period simple and exponential moving averages are holding up as support. We came right down to this in Friday's session, and we closed above that. So that support is holding for right now. We'll see if it's able to continue. And we're above all the other moving averages here that are all on one chart. And we're positive with the parabolic SAR. Now, the problem with this is the weekly chart, and it takes longer for this to update. We're actually negative now on the daily side, but longer term, this still is looking positive. And then this is a 20-period simple moving average of the open, high, low, and close, which produces a mini rainbow. As we've been going up, if we did see any kind of a pullback, these moving averages ended up providing support. Now we're coming down, and for the first time in a while, we're actually hitting more the middle part of the rainbow. But I'm still treating this as positive because the lines are still ever so slightly going up, and we haven't actually fallen below the rainbow, at least yet. We're still looking fairly positive with our advanced decline line studies. All the indexes are still above their moving average. The only exception could be the small caps, which are coming right back down to their moving average. And the reason why I'm calling this positive, because we're still in a downtrend here and we're looking a little vulnerable with price here on the daily chart for the NASDAQ, is that we're above both of the moving averages. And the longer we can stay up here, even if we see a bit of a decline from this point, we might end up seeing a golden cross here pretty soon. It hasn't happened yet, though. And we're almost ready to see a golden cross with the NASDAQ 100. Even though you look at the bars where we were going up and setting these higher highs and higher lows, that seems to be a little bit in jeopardy right now, but we're improving as far as the longer term trend. Wilshire 5000, still above its 200-day moving average. Now, this is still a downtrend. The blue line is a 50-period moving average, and it's still below the 200, but we've been hanging out above both of the moving averages now for quite a while, and that's why I'm treating this more as positive. And the same thing is true with the total U.S. stock ETF. It's another broad market measure that we follow. The financial sector, where a lot of the other indexes actually have seen a death cross where the trend has turned down, this has still maintained an uptrend, even though it was under pressure with everything else in March and into April. And I'm keeping this on the positive side too. Now, a week ago when I did this video, I put this on the negative side, saying, okay, we've come right down to the 200-day moving average with the financial sector to S&P 500 ratio. And so far, this is holding up. We've been able to bounce up off of this. We'll see if that can continue. And the FANG index, one of the stronger areas of the market, but even it's been just floating sideways here recently. But we did see a recent golden cross, and we're above both of the moving averages. And the staples to tech ratio, for the most part, has been declining, and that's more positive. That means that staples are underperforming tech, or value is underperforming growth. And we want this ratio to continue to decline. And we look at another stock to bond ratio, and even though we're coming down and seeing a little bit of weakness, this is still holding up. And I don't have a lot of charts to show you that show different indexes because they're all pretty much saying the same thing. Above the rainbow, but pulling back. So it's still holding up for right now. Now, the way the market uses this is if they're more favorable to stocks than to 3 to 7 year bonds, that means the market is anticipating a soft landing, meaning that we will not go into a recession. And you can see that was really in doubt as we were declining in March and then into April. But since then, we've been recovering, and for at least as of Friday's close, this is still holding up. And we see a very similar thing here. That's why I'm not showing a bunch of charts, because they would all show you the same thing. But I did want to show the QQQs, which is the NASDAQ 100, the 3 to 7 year bonds, improving, but pulling back into the top end of the rainbow. The tech sector to 3 to 7 year bonds, still holding up for the time being. And then the Qs, which are growth to small caps, which I'm not quite sure what they are, because that's ultimate growth. But we're still going up here. Now, back in the dot-com boom and then ultimate bust, we saw this ratio really coming down, and that led to a very severe bear market. We're not seeing that happening, at least yet, over here on the right-hand side. Then we look at growth versus value, the NASDAQ 100 versus the Dow. This is still above the red line, and you can see back in the late 90s where we were just skyrocketing up, and then we went in to the bear market in 2000, then 9/11 happened and all that, and this really took a hit. Well, it's doing okay, at least for right now. And then typically when this is going up, that means the S&P are outperforming utilities, and that tends to be more positive. And for the most part, we have been going up here. We were wondering if that is able to continue. And this is a broad market measure of a 5-period moving average of the highs minus the lows. Even though we're declining, we're still above zero with this measure. And another ratio, staples to S&P 500. Generally, when this is going down, that's more positive for the S&P. And then we look at semis to tech. Now, we want semis and tech to do well, but when semis are doing even better, this ratio goes up. And it has been improving here. We'll see if that's going to get hit this week or if it's going to continue to show some strength. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now we switch over to the negative side. Since we had a down week, I mean, it was virtually unchanged on the week. We were down 0.15%, but it was still a down week nonetheless. Plus, the market was closed on Thursday. We set most of the strength in Monday's session. We gapped higher and then really took it up here. And we pretty much topped out at 6,050. And that was the high that we set in the previous week. So that's starting to produce some pretty significant overhead resistance. And then we drifted down from that. Then we did see some late day selling on Tuesday, and we saw some early buying. This is kind of typical here. You have the folks that are more rah, buy the dip, buy the dip. They start coming in, and then this kind of fizzles out, and then we spend the rest of the day coming down. But now this was Wednesday when the Fed made their announcement, and we saw some initial gyration that looked mostly positive, but then we dropped down lower and did the gyrating down below this daily pivot and ended up closing down. We did have a gap higher on Friday, but then immediately set the high and then ended up drifting lower. Now, this was either triple or quadruple witching. This is every quarter we had this massive options expiration day, and that was on Friday. So some of that could be directed around what was happening that way. Then we were looking a lot more positive here as far as sentiment. Now, when this is going up, that's more positive. When this is going down, that's more negative, which is kind of what's happening right now. When you look at the bigger picture here, it's when we get near or at 75 or we drop down below 25, that's when we consider using this as a contrarian indicator. But we did get a pretty high reading here, and we have typically been dropping back lately. So that's turning a little bit more negative. And then this is a short-term trend type of measure here called the bow tie, where we see this fluorescent green moving average. And we were pretty much seeing that going up, and then it started to level off, and then it saw a little bit of upside move. Well, now it's starting to level off, and we're spending quite a bit more time below the moving average. Now, the 20-period exponential moving average, which is in red here, that's still holding up for right now. We'll see if that ends up getting challenged. And this is the condition of the short-term trend based on 20 periods. We're spending a number of days below both the green line and the blue line, and now the lines are starting to roll over. And that's just showing a little bit more vulnerability. Then we look at the intermediate term trend based on 50 periods. The lines are still going up, but we've been dropping back below the red line, which is a triple exponential moving average. If we start to drop down here, it's going to roll these lines back over, and now the intermediate term trend is in danger of seeing some pressure. We are above 20 with the VIX, and when we're above 20, that's when we see negative annualized returns, and we are currently above that right now. Now, this isn't blatantly negative, but it's not really positive either. We're seeing the 5-day moving average of the highs minus lows. Those are going down, and the 10-day is going down, but it's starting to flatten out here recently. But it's not that we're seeing a real expansion of the new lows. We're seeing more of a contraction of the new highs. That's what's causing these moving averages to roll over. So it's not really, really negative, but the fact that both of these lines are going down does suggest some negativity. Now, we have 3 smart money indicators that we follow. This is smart money indicator number 1. We're negative. We dropped below the red line here. That means this has turned negative. That's more longer term. Then we use a boom indicator, which is a modified MACD. This has been really going lower too. We were going sideways there for quite some time. Now we're starting to see a little bit more weakness here. So this is negative. And we look at an advanced decline ratio. In the short term, even though we bounced up a bit on Friday, we're still below 0. We're a little bit more positive here in the intermediate term based on 39 periods because it's still it's above 0 right now. And then this is smart money indicator number 2, the Chaikin money flow. The histogram is going down and the red line's going down. That's negative. And the Chaikin oscillator going down, dropping below the midpoint. So our 3 smart money indicators are now negative. And this is a daily chart, and I've been trying to point this out. As we were going up, we set higher highs and higher lows, and then we hit this pivot point, which was already on the chart beforehand, and I update these every day. We hit that. That's about at the 50 level for the S&P, and we have not been able to get back above that. And now we're starting to drop back down here, and this series of lower highs seems to be, excuse me, higher lows, seems to be in jeopardy now. Now, it's a little bit hard to see because we already have the pivot points for July that are being put on the chart here. And we have spent quite a bit of time above both of these moving averages. And the longer we stay up here, the more we might generate a golden cross. Then on the bottom, you can see Friday session. We just had a massive influx of volume there. We are still below zero with the S&P McClellan oscillator. So when it's below zero, the summation index is declining based on price. We're also declining based on volume. We're also below zero with the NYSE McClellan oscillator. So we're declining with the summation index for the NYSE based on price as well as volume. And we're finally rolling over here with the slope oscillator. It was trying to go back negative and already extreme positive above the green line. But now it's rolling over. And then we have another short-term oscillator, the TSI. It's now turning negative. And then the three intermediate term oscillators, the MACD, PMO, and PPO, they're starting to go negative. And then longer term, we have the TRIX and KST. They're still extreme positive, and now they're coming down and dropping below their moving average. And the Copic curve, it almost crossed over the red line, but nope. Then we ended up having some pressure on the market, and now we're looking more negative here. We're below zero and declining based on price and volume with the Swinland Trading Oscillator. We're declining below its moving average with the bullish percent index, and we're declining with the NYSE bullish percent index, and we're declining and no longer extreme with the NASDAQ 100 bullish percent index. And we're negative here. This is the long-term trend of the AD with the ADX. Now we're still positive on the daily side because the green lines are still above the red line. Here, the red line's still above the green line, even though this is a weakening trend. And the parabolic SAR is still positive on the weekly chart. Well, here it turned negative on the daily chart, and this is considered a primary indicator. And we're below 50 with those stocks in the S&P above their 200-day moving average. And we're still below the red line with the special K. This is the long-term oscillator that continues to be negative. Now, this was positive, and I pointed this out a week ago. We were really moving up, and we got above the green line. That means that 90% of stocks in the S&P were going up with the 10-day average of their highs minus their lows, and that's longer-term, more internal strength. This is now coming back down now. Now, the context is that it's negative, even though we're still above 50. See, and then this one, as I've been pointing out in other videos too, you could take this as positive or negative. We're seeing a bit of a disconnect between the weighted version of the S&P and the red line, which is an equal weighted version of the S&P. Now, this could be seen as positive in the, whoa, look at how better the S&P is holding up. They're on different scales, but you can see they tend to move in tandem with each other and not get too far apart from each other. Well, they're getting kind of far apart now. So if you think that the mega caps are going to hold up and actually show some growth, you like, or it doesn't bother you that the S&P 500 weighted index is above the red line. The negative side is this means that fewer stocks are really showing any strength right now. So it depends on your personal perspective. And the Dow just cannot seem to stay above its 200-day moving average. And the momentum for the NASDAQ 100 is negative. And small caps just really struggling now. Above their 50-day moving average, but still below their 200. This is the Russell 2000 small caps. We came up, we hit the 200-day moving average, and have been pretty much retreating since then. And mid caps, at best going sideways, just cannot seem to get above their 200-day moving average. And then home construction is still negative overall. The semiconductors, the reason why these are negative is because we're technically still in a negative trend. Now, this could easily switch over to positive. But there was some news coming out that there was this waiver that, okay, semiconductor companies can ship their technology to China. There's talk that that might be done away with. And so we saw a bit of a hit being taken by the semiconductors in Friday's session. Now, if we stay above both of these lines, this could generate a golden cross pretty soon. And I look at a lot of different things with semiconductors. This is the SMH semiconductor ETF. It is showing some improvement, but technically still negative. We're above the rainbow here, and I wanted to keep this chart. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Together. Okay. Then things that we're watching, jobless claims. Now, we get concerned if we're seeing initial jobless claims really going up. Well, in the latest reading, they actually came down, even though the 4-week moving average is continuing to go up. Where we're a little bit more concerned, even though they retraced a little bit here, is the continuing claims. These are folks that are unemployed for longer periods of time. We broke out of this range that we had been in for quite some time, but we're still below the 2 million mark for this. If we see this really start to go up, that's going to turn more negative. And except for an occasional day here and there, we had one at the end of May. Then here's the triple or quadruple witching for options expiration. But other than that, we're pretty much consistently below average with volume. And we're still below 4.5% with the 10-year yield, and that tends to be more positive right now. Then we look at the interplay between cash and 3 to 7 year bonds. We try to get some clues to say, okay, what does the market think? Regardless, there's videos you can watch that say inflation's going through the roof or it's going to go back down to zero, whatever. I pay attention to what the market's actually telling. And this is one of the charts that we look at. The relationship between cash and 3 to 7 year bonds. Now, if this was going up, that means people would be keeping cash in their pockets more because they think interest rates are going to go higher. And so this ratio ends up going up. Now, when they think interest rates have topped out and they're going to come down, they stop cash and they put their money into 3 to 7 year bonds, and that makes this ratio go down. We're not really seeing much conviction either way right now with this particular measure. And then we look at tips. Tips are what people get into when they're concerned about inflation and interest rates going up. When they're not concerned about that, they get into 3 to 7 year bonds, which makes this ratio go down. We're kind of not really showing any conviction here. Then we use that same thing, and instead of looking at 3 to 7 year bonds, we look at tips to 7 to 10 year bonds, not showing an awful lot of conviction. And then we want to keep an eye on the 10-year to the 3-month yield curve. We went inverted one day this past week, and we're not there now. We're uninverted at this point, meaning we're getting a positive result. But this is not normal for it to happen, but it seems like this really improves, then it comes back and goes inverted, then it improves, now it's coming back and being inverted again. So we just want to keep an eye on that one. We look at the spread between risky and not as risky bonds. Risky bonds would be like junk bonds. Not risky bonds would be government bonds, which are considered to be safe. If there was a lot of fear in the market, which could change this week, we'll have to see, this chart would really be going down. That means there's a real increase in fear. But for the recent times anyway, this hasn't really been showing much conviction at all. Oil likely to really spike up. We were not very long ago in the upper 50s. Then we got back up into the 60s. Now we're in the mid 70s. There's some threats that the Iran controls the Strait of Hormuz. And are they going to shut it down? What's that going to do? Is that because China gets a lot of their oil from Iran? Is that going to make China angry? Are they going to keep the Strait of Hormuz open? A lot of variables there. We don't really know the answers to it this time, but it's likely that oil is at least going to go higher before it probably goes lower. Then we look at a ratio between the semiconductors, which are growth, and the Dow. And we have been improving with this. We're finally breaking out of this series of lower highs here, but we'll see if that comes under pressure in the upcoming week. And then these are just different ratios that we like to keep an eye on. And for the most part, when we look at the weighted version of discretionary to staples, sideways. The equal weighted version of discretionary to staples, sideways. Tech to utilities, showing some strength, but not really a lot of follow through here. Biotech to healthcare, it's not the biotech's doing all that great, just healthcare has been doing so terrible. So we're seeing this ratio actually a little bit more positive. And we look at hotels to utilities. This is pretty much sideways to actually going down. Then these are considered bellwether stocks here. Semiconductors, sideways. Home builders, down. Transportation, sideways at best. Retail, sideways. Then declining with the regional banks with a little bit of a bounce up recently. And then the ratio between gold and the SPY. And it's not that the SPY is doing all that well. It's that gold's been going sideways and the S&P's been going sideways. So that makes this ratio continue to go down. Then U.S. versus international stocks. And I tried to redraw this on here. Going back to the early part of February, this is when U.S. stocks really started to underperform international stocks. Well, since that time, we've kind of leveled out and trying to improve here. But after it really had been declining, we're seeing a general improvement with this chart. Dollar, just been getting hammered here in a downtrend below 100, even below 99 now. And then the German DAX, that's the biggest stock market in the EU, currently coming back to its 50-day moving average after setting a series of all-time highs. Still in a really solid uptrend. Now, we'll see if it comes under pressure as well. And then this is a relationship or ratio with the U.S. stocks versus German stocks. When this is going down, that means German stocks are outperforming. Lately, we're seeing U.S. stocks starting to come back and hold up a little bit better. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.